cost of goods sold is one of the easiest areas of income statement. Just three things to adjust and you have got an answer. But many people tend to struggle with the double entries and logic of cost of goods. So let's talk about that. First of all, remember one thing: whatever is written in cost of goods sold, those are three things: opening inventory, purchases, and your closing inventory. Now, closing inventory is something that is extracted out of or the leftover of purchases and opening inventory. So mainly what we have to understand here is that when we are recognizing opening inventory or purchases, we have to move a balance from their account to the income statement account. What do I mean by that? Let's take an example. If you want to enter a new room, do you have to leave the old room behind when to basically move to the new room? Exactly in this way, when you're looking at opening inventory or purchases, they have their separate T accounts. So they have to be transferred from the T accounts to the income statement. Now, how do we do that? Opening inventory is basically recognized as an asset. So if you want to transfer it into the income statement, how will we be basically recognizing it? The opening inventory will be recognized in a way that you are going to credit inventory. You're going to close the inventory account by crediting it and open the expense account or increase the expenses in the income statement as cost of goods sold debit. So this way, you are increasing the expense for the year in the income statement. Then comes the purchases. In purchases, obviously we have recognized our entry initially, purchases debit and bank or cash or payables, whatever credit. Now the purchases account has to be closed and the amounts, the units, the cost of the units to be transferred to the income statement as an expense. So we are going to make a double entry: income statement debit or cost of goods sold debit and purchases credit. So now what you have done is you have basically transferred the cost of the opening inventory and the purchases to the income statement. Now the total cost of inventory available is present in the income statement. Now the closing inventory is the left of inventory that is not sold. So what do we do here is we basically de-recognize the particular expense or the cost of the inventory that is not sold in the year. So that we only relate the expense to the income of the unit sold. So in closing inventory, what do we do is we basically debit the inventory, and credit the income statement here. We reduce the expenditure that was already recorded by the opening inventory and purchases, and we basically increase the inventory because inventory account is at the position of zero at this stage because all the inventory from opening and purchases is already transferred to the income statement. So in the closing inventory, double entry basically is cost of goods sold credit and income statement debit. So this is how we basically relate double entries into the income statement. Now, if you want to learn some more logical explanations of double entries and adjustments in the financial statements, stay tuned with us.